Front and center this hour, the rally in the aftermath, what the Fed's decision on rates and that reaction means to your money in the months ahead. We debate that now with the investment committee. We'll also get you ready for Apple and Amazon. Of course, those earnings coming with me in overtime. Joining us for the hour today right here, Carrie Firestone, Shannon Saccocia is here, Sarat, Sethi as well, and right here on set is Steve Weiss. Let's go to the wall. It is 12 noon in the East, of course. Let's check the markets and see where we are, because we've kind of been all over the place. And here we are with a little bit of follow through positive now. 32,383. That's where the Dow sits. That's good for 186, a bit better than 0.5%. It's the NASDAQ, 0.5%. S&P doing pretty good at the moment. 10-year note yield 269. The big question, I think, Weiss, at this point in time is, did the market get it right? Did the market get it right after the Fed chair? Because the narrative was he was more dovish, that you're basically peak inflation, peak rate hikes, just had 275s, not going to get anything bigger than that. You may not get another 75. That we're closer to the end, that he's going meeting by meeting. He acknowledged the economy is slowing and that rate hikes have yet to work their way through the system. And the market apparently loved it.
Yeah, the market did, and I do think the market got it right. And last week when I was on, I commented, look, if he gives a nod to the fact that commodity prices have come down, maybe not say that specifically, but that there's been some relief on the inflation pressures, and I never expected him, nobody should have expected him to do a complete 180, that the market would take any sign positively, and particularly, I felt that given that the market was obviously in a glass half full, as it always is, rather than glass half empty, as was a month ago. So when the press conference started, I did put on some pretty sizable positions in the Qs, VOO, and SMH. Came out of the VOO, actually came out of the Qs this morning, but went back in when I saw the markets recovering. It's so unusual to have a big move like yesterday post a Fed meeting where he really didn't say we're done. He's actually going to keep going. So I wouldn't read it as dovish as perhaps the rest of the market. But look, I think the market can continue to rally here for a little bit. You've got the big news out of the way. Now, of course, if you have Apple and Amazon really miss today, which I do not expect, I do expect misses, then it's a different story. But right now, and if you don't have inflation, a ridiculous number tomorrow, I think you can continue to rally. But then as we get into the fall, it's going to be a different story.
Okay. Sarat, how would you answer the question? Did the market get it right? Is it getting it right at the moment? 10 years down at 269. Stocks are trying to get the follow through from that big rip yesterday.
I think it did. I mean, he definitely gave a tone that, listen, we're data dependent, which he's been saying all along. But he's also saying, like, look, things are slowing down and we're not in this growth phase, and we're going to stay really focused on the data. And I think the data that they're going to be looking at is also going to be employment, because as soon as employment rolls over, that's when the Fed will actually probably start signaling like, hey, we're going to get closer to the end, because the wage increases is a big part of this inflation component. And you're seeing all the other stuff coming down, commodities, input prices, inventories. I mean, the big slowdown is inventories, the glut of inventories that we have. So I do think what they said was, hey, we're not just going straight to keep on raising rates. We're on that course. And of course, the data supports it. We will. But if not, we will then relook at the numbers.
Carrie, should we be more optimistic today than we were a day ago, or no?
Well, I think the market was optimistic yesterday, and it is today. It was an interesting start. It looked like it would be weak, and then it came back because as Jay Paul said yesterday, it feels like it tastes right. It's the Goldilocks scenario, and that we may be in a recession. He said unlikely, but if the second quarter was a slowdown and the first quarter -2 in a row, you need a few other factors. But if we're having a recession and things aren't falling off a cliff, I think that's pretty good news. We're having earnings that are not as bad as expected. I mean, that's the big catchphrase, that we're all seeing numbers that are weak, but they're not horribly weak for the most part. A few have been very disappointing, like Snap, but Netflix bad, but not too bad. And Google bad, but again, the market liked it. If we can continue on that trajectory and get through this weakness in the economy, I think that says that perhaps by the end of the year, we'll have run the course, meaning inflation will be down, interest rates have come down already, employment may be down, but that would be, as Sarat said, wages could be down, and that's a better picture. The market, by the way, is showing some support at the 50-day moving average. I think that's a very good sign for the market. We were well below it. Now we're above it, and the market needs to sort of stabilize here, and then it can move forward over the next few months, possibly.
Shan, the tide has turned, it sounds like, in terms of what everybody here is suggesting, though Evercore ISI isn't really buying that. They say this is a bear market rally, implying likely a lower low this year or next before the bear ends. It goes to the question of whether the market is trying to read into something that didn't happen yesterday, that Jay Powell didn't say.
Yeah, I think that there are two sides to this coin. I actually feel that Powell was fairly emphatic on the fact that they continue to worry about inflation. I think that although we're seeing improvement, just think about where we're starting from, 9.1% last month. Wage growth, at somewhere in the neighborhood of 3% and declining, as already pointed out. And so that spread is pretty meaningful. And the decline in discretionary income is certainly bearing out in spending. If you look at and you break down this GDP print, Scott, you see goods coming way down, services up only a little bit, housing construction coming way down, business expenditures coming way down. So the way that I look at this is, this is what we sort of expected. And Powell does have some cover in that the economy is doing for him what he needs it to do, especially in that goods number with that goods spending coming way down. But I think we have a couple more months here before we reach a level of consumer spending and discretionary income that people can get comfortable again that 2023 is going to be a better year from an overall growth perspective.
All right. Scott Minerd, Guggenheim, says the markets are relieved that the Fed is in the process of pivoting. The question is, are they really in the process of pivoting?